Okay, without further ado, let's go ahead and get this started. Try to have some fun while we're doing it. Appreciate Mark Perlberg for coming on, joining us on our fiscal fitness training. Just trying to be able to educate the public out there in the real estate space, as well as, so more importantly, tax. Um, so a little bit, I'll let Mark introduce yourself, but again, a little bit about Mark. He's founder of Mark Perlberg, Rockstar CPA, specifically targeting real estate. So those real estate professionals out there, or if you're just investing in real estate, definitely he's going to bring a lot of powerful tax strategies, business insights, and different ways to support you on your investment journey. So definitely appreciate you taking the time to be with us. So a little bit about us, Rise Capital out there, again, trying to educate people on the power of just being able to invest in real estate, whether it's actively or passively. Again, try to get that education out there. Today, we're going to kind of be concentrating on tax savings, what the impacts, the implications of taxes are on real estate, the benefits, the detriments to it. I remember several years ago, before I got into real estate, my idea of tax savings was just make more money. The more money I can make, I don't have to worry about the taxes. That was a horrible strategy. Very, very bad strategy. It is a strategy. I think it's a strategy a ton of CEOs probably use. Corporate executives use, just make more money and offset whatever you got to pay on the taxes. I actually heard a keynote speaker talk about it one time, and that was his tax epiphany. But hopefully, we're going to get a much better insights from Mark and the right way to do it, not my old way of doing it. So, Mark, go ahead and introduce yourself and uh, get that started.
Sure. Thanks for having me. My name is Mark Perlberg. I'm a CPA, certified tax coach, certified tax planner. And as you said, we specialize in delivering advanced tax reduction strategies for real estate investors, high income earners, and real estate investors. I would say about close to 95, 96% of our clients are real estate investors. And we look at the holistic picture of all their sources of income, including the real estate, in order to determine the best strategy to minimize taxes and build wealth.
Awesome. Again, definitely thanks for being here. Thanks to everybody else too, for whoever's tuning in on LinkedIn, as well as join us on this Google Meet. Appreciate you guys being there. We want to just have fun, keep it as informal, as much fun as we possibly can have talking about taxes. That's what we want to do.
Tall order.
Well, you know what? Let's not say about taxes. Let's have fun figuring out ways how we can keep more of our capital. That's probably a little bit more fun to talk about. And we're just gonna keep it as informal as possible. You guys have questions? Dump it just throw it in the chat. We'll try to get to as many as we possibly can in the time that we have allotted here. But it's just going to be a Q&A. I'm going to shoot some questions off to Mark, and hope we'll get some extremely valuable insight off of it. So first question here, Mark. So we're approaching the end of the year. Most people's fiscal year is just typical calendar year. What are some last minute tax saving strategies that people can still implement leading up until the end of the fiscal or calendar?
Yeah, so I mean, there's a lot that we can do. I would say almost any strategy we would think of is still available unless it relies on these actions being taken before the transaction occurs. So we're about to do Q4 tax planning for all of our clients, and some of the things we look at are entity structures, charitable deductions, and if you really dive deep into some advanced strategies, there are some charitable structuring and deduction strategies where the super wealthy are creating massive charitable deductions for a fraction of the cost. We are doing other things we're considering are retirement accounts. If your income's down, we're looking at Roth conversions. Income's a little bit higher, maybe we put more into those tax deferred accounts like 401ks and the IRAs. And one thing that we always look at also is capital gains planning. And are there significant capital gains events? If there are capital gains events, let's say we sold real estate for a gain, or let's say we're about to sell real estate for a gain or some stock for a gain, we are going to look at what can we do to mitigate those capital gains. And there's a variety of year-end capital gains tax strategies we can do as well. And then finally here, another thing that a lot of what we think about here is not only creating tax savings for the current year, but what can we do to set us up for success for future tax savings? And this is where a lot of people drop off. So a lot of accountants say, okay, we got rep status, we do a cost seg, we got you at a $0 tax bracket, our work is done. And your work is not done, because you don't want to let a good low tax bracket go to waste. So the final step here is we also want to think about what actions can we do now to prevent future taxation. So maybe we're in a $0 tax bracket. That's, like we said earlier, we roll things into a Roth, or maybe we recognize some income at a lower bracket now to free capital on a stock disposition, so there's no capital gains later. So there's all sorts of things when we're done to really make sure we're optimizing current and future taxes.
That's awesome. Let me try to break it down a bit, because I'm pretty sure we're going to have both experienced and newer investors. Maybe take a few steps back. What is capital gains? How does it happen? What is it? What is normally the tax rate of capital gains? And break that down, and maybe in comparison to just active income.
Sure. So your capital gains is when you sell an asset in your business, or an asset that's meant to generate cash, or you could potentially have capital gains on the sale of your your primary residence. So usually that amount is excluded. For most of you, what you're going to see is capital gains for the sale of rental real estate for profit, or the sale of stocks for profit. But we also do capital gains for other transactions, like the disposition of your own business or shares in your business. Plenty of other reasons. So those are typical capital gains or capital loss events, and they're going to be taxed at different rates at a graduated rate. It can be taxed if you are married filing joint and you're at a $0 income, your first $80,000 is untaxed. After that, it's taxed at 15%, and then it's taxed at 20%, and then on top of that, you have what's called the net investment income tax. If your non-earned income reaches a certain threshold, you could potentially pay an additional 3.8 on top of that. And then another thing that people forget to realize is you're also probably going to pay some state level income tax. And then finally, again, with depreciation, with real estate, a lot of people forget to consider depreciation recapture, which is a form of capital gains tax that can be taxed as high as your federal marginal tax bracket. And then there's short-term capital gains, which is also taxed at your marginal bracket at the federal level, and usually the same way at the state level. But in all these circumstances, you're paying less. Your capital gains are going to be taxed less than your ordinary income. You're not paying FICA taxes and self-employment taxes on it. So it is more favorable, but those capital gains events can be deadly if you don't have a plan in place to mitigate them.
That's awesome, man. Thanks for elaborating on that. I got one more that you brought up that I just want to elaborate on, just for those who are not 100% sure. So you brought up, you actually just brought up Roth, and then obviously you have your traditional IRA and the events of rollover, right? If you want to defer on the traditional side or you want to roll over, maybe talk a little bit more about that. What the heck is a rollover? What is a tax deferred account? And how all of that works. Just try to kind of summarize it, just for those that are not 100% sure exactly what that means.
Yeah, let's talk about this for you guys. So, if you have you're putting money to a 401k or an IRA, when you put those funds in there, it reduces your taxes by every dollar you put in. So if you put in $20,000 into a 401k, you're reducing your taxable income in that year of contribution by $20,000. But eventually, when the money comes out of that 401k, you're going to be taxed at your marginal rate on those funds. So it's going to grow tax deferred, and then when you eventually pay taxes, you could be sitting on a ticking tax time bomb. So one of the things we want to think about if we have the opportunity is to time the release of your IRA or your 401k so we're not paying taxes on it all at once. So that's why we want to align a strategy here. We want to consider your tax brackets and what your taxable income is and see if there's opportunity to recognize taxation on taking the funds out of that 401k or IRA at the lowest rate possible. And when you convert it from a 401k into an IRA, you pay taxes on whatever you take out at your marginal rate. But then if you put it into a Roth, it grows tax free. And then when you take money out of the Roth, you don't pay any more taxes when you take the funds out of the Roth IRA.
That is absolute gold. So again, if you guys are tuning in, like that is super important. Just that right there, getting a CPA to be able to understand exactly how you should be doing that is definitely invaluable, right? Save as much money as you can now and save as much money as you can in the future, and planning it correctly, because you could, exactly like Mark said, you could be sitting on a ticking time bomb and just not know it, right? You're looking at your traditional retirement account, and wow, it's definitely growing. Depending on if you're in equities or real estate, doesn't, honestly, at that point doesn't matter. But kind of understanding what are the implications or impact in the future, and making sure that you plan for that accordingly. It's super powerful. Thank you.
And we like to align this with what we call the job exit tax strategy. So let's say you quit your job and you become a full-time real estate investor, or let's say you're living off your real estate and you have enough passive income to live on, and you quit your W-2. Now you're going to be in a $0 bracket, or maybe we have some losses. So now is when we start thinking, hey, let's start timing these conversions and potentially pay zero taxes and rolling it into the Roth and having it grow tax-free in that Roth for a brighter future.
Yeah, exactly. All right, moving on. What are the biggest tax mistakes that a high-income individual typically make, like me, that just make more money and avoid? I mean, you're not going to avoid taxes, but what are the mistakes that they typically make, and how can they avoid them?
So the biggest mistake, well, I would say these are mistakes that most high-income earners make, which is they work with a compliance-focused tax CPA, and their goal is to just report your taxes, and they don't have any ideas on how to reduce your taxes. And a lot of people, it's not their fault. It's just they don't realize that there's a whole world of strategies out there. Especially once your income exceeds, I would say, $500,000, or maybe even exceeds $250,000, there are opportunities to reduce your taxes, even if you just have a W-2 job that a normal accountant, a normal tax preparer is just not going to be aware of. They haven't taken the time, and they don't even charge or design their business to give them the capabilities to identify ways to reduce your taxes. So first is working with the wrong person. Then another thing I see is people trying to DIY their own tax plan. So they're going on bigger pockets. They get all excited about 1031s, and they 1031 into a property of a lower basis. Or I've seen people DIY 1031s where the replacement property actually, we saw a 1031 where it actually reduced their taxes, if you can imagine that being possible. I mean, it increased their taxes, if you can imagine that being possible, because they were selling it at a loss and they deferred their loss. So thinking that, that you can figure this out on your spare time, just like any other profession, I wouldn't want to dabble in dentistry and do my own root canals. And that should be the same for anybody who thinks that, even though they have another, they work in finance, or let's say they're a physician or whatever, that they have enough time and capacity to do the best possible work on their own tax planning.
That's a definite story. The 1031 a loss. That doesn't even make sense. Maybe I don't think we're even going to talk about this. Maybe for those that don't understand what a 1031 is, maybe elaborate a little bit more on that, just so they can understand. Break it down for them. What is 1031? What does it do? And all of that fun stuff.
At a high level, what a 1031 does is it allows you to defer a capital gain event by buying another property of equal or greater value. So basically what you're doing is you're saying, instead of just selling this rental property for a profit, we're actually going to sell it, but use our funds to replace it with a different property of equal or greater value. And therefore, the IRS allows us to defer that gain indefinitely and maybe never pay taxes on the gain. But this prospect did a 1031 and didn't realize he was selling his property at a loss. And no one told him. He was, reading the blogs and did a 1031. So now, instead of deferring a gain, he's deferring a loss. He would have been able to recognize that loss and use it to offset his taxes if he didn't do a 1031. So now he's overpaying in taxes and overpaying in professional fees to do the 1031.
That's crazy. That's absolutely crazy. That's a new one. I've never heard of that one yet. So
that was the first.
Yeah. Okay. No wonder why I've never heard of it. I'm sure it's not a normal thing, because again, the 1031 is defer capital gains. Maybe there's a new strategy that we don't know to defer losses. I mean, losses is automatically going to get rolled over, but I don't know. Maybe there's something new there.
And just a little bit more on what people miss out on, what the high income earners are missing out on, especially when you get above $500,000, there are financial vehicles and ways to invest in different things, or there are ways that you can kind of structure a side business or certain charitable vehicles, where even if you're just a high income earning W-2 employee, there are ways that you can reduce your taxes significantly. And those are just things that take a lot of research and understanding of the tax law to implement, and you're just not going to get that from someone who doesn't specialize in that type of work.
Yeah, absolutely. Okay, thank you very much on that. Kind of moving on. What are some tax advantages, if any, of investing in real estate, particularly with passive real estate investments?
Yeah, so when you're talking about investing into tax of real estate, I think one of the most wonderful things is that you're going to have cash flow, and you're going to have, you're going to have regular disposition. You're going to have regular distributions hitting your account, and then the depreciation is going to offset that cash flow. And usually those investments are going to run cost segregation studies that generate additional depreciation. And that depreciation is going to make sure that you're going to go for a very long time without paying any taxes on the cash that you're going to receive. So now I could go on a tangent talking about material participation in real estate professional tax status, but here's the thing. Before we get carried away with that, a lot of people don't have the time, energy, or desire to deal with tenants, toilet paper, and trash, and they still want to see how they can win this tax game. So when you invest passively, and let's say we don't have the benefits of rep status or any of that other stuff, we're still setting a portion of our funds aside that are going to grow, and they're going to compound year after year. And if you can set aside a decent amount each year, you're building this other bucket of income here that is incredibly tax advantaged. And so when you're passive, you're going to see that opportunity. And then also with real estate, because you're not using the depreciation entirely to offset all your revenue, because you have more losses than you even need, you're going to have negative income statements hitting your account each year on the real estate side. Those funds will eventually offset your capital gains events if you continue to invest. And also you're going to see instances where you get cash through maybe a cash out refi, or you're going to get more money coming your way from a refi, and that's going to be untaxed too. So there's still lots of opportunities as a passive investor.
Awesome. I definitely want to break down. You threw out a whole bunch of nuggets there. I definitely want to break some down. Maybe talk a little bit more about, because you said cost segregation, what a cost segregation is, and maybe a little bit more about depreciation, just to, again, from a super high level, just so that we can get some clarity on that aspect of it.
So let's say you guys are investing in a fund with some real estate rentals. Those real estate rentals have property, and the property is going to get a depreciation deduction to account for the expected wear and tear of the building that you own. And that is going to be depreciated normally over 27.5 years. And however, with a cost segregation study, we're going to evaluate this building and identify items that depreciate faster. So this could be what we call land improvements, like driveways and parking lots that they're going to give you a 15-year life. And then they could also be items like that are treated as personal property and depreciate over 5 years. And those could be cabinetry, carpets, blinds, ceiling fans, refrigerators, et cetera, et cetera. And those items are going to depreciate faster over 5 years, and they'll also qualify for bonus depreciation, meaning in 2023 we'll write off 80% of the value in year one. So we're picking out this real estate and we're deducting a big chunk of it up front, and we're creating massive deductions. And those deductions are going to offset the rental revenue. And even if you're cash flow positive and you're bringing in more cash than you're spending on interest and overhead, when you file the return, you're going to have a paper loss created from all of that depreciation, which is going to ensure that you're not paying taxes on that rental revenue.
That's awesome. And maybe just one more time, how does that impact so obviously it can impact the passive income you have from just collecting rent, but say you go to sell that, how does that impact that capital event? You mentioned it, but kind of want to reiterate that, because I think a lot of people miss that all those components of it and how it all works in correlation to each other.
Yeah, and it is a very complex topic. So it would be, now I see some comments coming in, and I guess we'll address them at the end. But now, when you have a property that has depreciation and you sell it, that depreciation is what we call recaptured, meaning that you're going to eventually recognize income on what was taken as a deduction on that depreciation. So you're eventually going to have what's called depreciation recapture. However, I really wouldn't stress about that, because what you're going to do is, if you continue to invest in real estate, as you have depreciation recapture and potential capital gains on sales, your other sources of real estate, you're going to have lots of depreciation from the cost segs to offset the taxation on other depreciation recapture. But that's what we would expect. And also, like we said earlier, how you're going to have more losses than you need. You're going to have losses flowing through to your 1040 tax return. Those unused losses, because you're going to have more losses than you're not really going to be able to use your losses because they're passive. They're going to be activated, and they're going to offset future capital gain and depreciation recapture.
Yep. Did we want to? I'm okay going either way. We want to keep this kind of open. Did you want to touch on the questions now, or you want to take it at the end? I'm open. You tell me how you want to do it, Mark.
I mean, we can say whatever you guys want to do. I'm fine. We can save it for the end, or whatever you guys want to do.
Okay. Let's keep going, because I can't even see the questions coming in. Obviously, you can. Well, let's just keep going. And for those of you that have questions, I'm sure there's going to be some questions on LinkedIn as well. We'll we'll get to it at the very end. I think there's only a few more questions left on the presentation, so we'll have some time to cover your guys' questions as well. Okay, so one popular misconception is that owning real estate is always a tax benefit due to depreciation. Is this true? And could there be cases where it's a disadvantage?
Okay, so here's what I would say is, even let's say that you don't have access to depreciation here. Let's take depreciation out of the equation here, because we do see occasionally we'll get clients that invest in like wholesale properties that they buy for like $50,000, and there's minimal depreciation. So let's say that we don't have enough depreciation to offset our rental revenue. You're still paying less taxes on your profits than you would at a W-2 job, because it's passive income. So you're not paying Social Security or Medicare taxes on that. So because it's passive, you're still going to have, even if you are finding yourself paying taxes on it, whether it's through passive rental profits or if it is capital gains in the future, you're going to have a more favorable tax treatment because you get the long-term capital gain treatment. assuming you have it for over a year, or you're not going to pay any uh, FICA taxes on your profits from the real estate. Not to mention the fact that you can mitigate future capital gains taxes with things like the 1031 exchange.
So all in all, I mean, let me just summarize this. There's a lot more benefits than there are disadvantages by just getting into real estate in general. And more important, I mean, just like even we're talking a little bit more about passive real estate, but just real estate in general.
Correct. Yeah,
Yeah.
we've looked at we can conclude that based on we've looked at a couple thousand tax returns for real estate investors, and they're doing pretty good.
Yeah, I don't even want to tell you what my tax bill was before and after.
Okay.
It's yeah, a gigantic world of difference.
We'll have to
Yeah,
talk.
yeah. Again, another misconception is that you have to be actively involved in real estate to reap. Well, we kind of covered a lot of this, but we can just cover it again. Actively involved in real estate to reap the tax benefits. Can passive investors also benefit, and how? Which we talked about, but we can go ahead and just reiterate it again.
Yeah, and I mean, I guess I'll just tell you why someone would say that is because if you have real estate professional tax status, or let's say you have a short-term rental where you self-manage a short-term rental, there are potential opportunities to use real estate to create paper losses that'll offset your W-2. If you're 100% passive and don't have those opportunities, the real estate will not reduce your taxes. You're not gonna be able to use those cost seg losses to offset your W-2 income or your job income. If you have other sources of passive income, like you have passive shares of another business, the real estate will reduce your taxes. Not a lot of people do that, but we've coached our clients on how to make those opportunities. But even if you set all of that aside, you still have opportunities here because of the advantageous tax treatment of your rental activity.
Yeah, that makes sense. Maybe talk a little bit, because I know you and I have had the discussion in the past on different ways that they could, and we don't offer these in the fund, in our fund, or even in any of our investments. But I mean, I think it's good education out there to just put out there. What are some maybe strategies that someone could? So say there's a higher income earner and they want to still be passive. That say a doctor or a lawyer, they just don't have the time to, or a CEO for that matter, and they just don't have the time to actively investing themselves. What are a few strategies that they could look into that can help offset some of their active income?
Yeah, so if you can get the spouse to get real estate professional tax status or have short-term rentals, that's one very common and popular opportunity. Some other opportunities now. Well, one thing is, let's say you have capital gains, you can defer them and potentially create a future $0 cap gains with qualified opportunity zone funds if you're concerned about capital gains tax. And then outside of real estate, other investment vehicles that will reduce your taxes that are very popular are oil and gas. So between 80 to 90 cents of every dollar you put in will be used to be deducted against your W-2 income or your business income. And that's really popular actually with a lot of our real estate investor clients, because a lot of them become exhausted and don't want any more tenants. So they want another way to put their cash somewhere that'll reduce their taxes, or they have all these losses from real estate such as yours. And they say, well, how can we use this real estate? Well, eventually that oil and gas is going to give you, in years 2 and beyond, they're going to give you positive taxable passive income. And now you can use your real estate losses to offset that and diversify your portfolio. And then we have some more advanced tax strategies involving charitable structures where, based on either the valuation or the timing of events, you can get a really large charitable deduction to offset anywhere from 30 to 60% of your income. And it'll cost you a small portion of that amount to create the deduction based on a difference between the valuation and purchase price, or the timing of when you're going to make that donation and when you're incurring the costs. So those are some more sophisticated, higher end strategies we do with our clients. And then there are some other things that are a little bit more aggressive that we we'll show the clients where it comes to maybe starting a small side business as tax advantaged, or things of that nature. And then that can also give you some tax deductions. But those things do require extra energy from the client.
I know that was good. A lot of great information there. I think we only have one or two more questions. Just trying to kind of wrap it up here, and we'll get to everyone else's questions. But how can people balance their investment portfolio? Well, we kind of just talked about that too. But how can people balance their investment portfolio to minimize their tax liability, particularly between stocks and real estate? And you sort of touched on some of that.
Yeah. So with capital gains, you can invest into qualified opportunity zones. That's great. You can invest with retirement accounts, which is fantastic. Now you're going to see more advantages by, if you're investing into real estate, you're going to probably see greater advantages putting the stocks into your Roth and investing outside of your retirement accounts for your real estate, because you're likely going to already see the tax advantages, so you don't need to shelter them with the Roth. Some other things you want to think about here is if you have real estate capital gains. Let's say we have $100,000 capital gain event. Well, maybe we have some potential capital losses that we can create by selling some of our stocks that are below the purchase price. So we can net those capital events against each other to make sure that we're optimizing our taxes. And then finally, what we talked about earlier is, taking it, if we can use the real estate to reduce your taxes, then seeing how that's going to impact your stock portfolio, and really taking a holistic picture at how do the stock market events create opportunities in real estate and vice versa.
That is interesting. I knew, I misconception I just learned. I thought that you couldn't use the stock losses. I know you could use it for other stock gains. I didn't know you could use it outside of stocks.
Yeah, that's an interesting one, right? Like you wouldn't think so, but you can use, even though you can't use, most of that passive income is kind of stuck there in that passive income bucket, but you can net your capital losses between your portfolio income and your investment income. So that does create some potential opportunities there.
Oh, that's awesome. That's awesome. Oh, thanks for that one. I gotta be more cognizant of that. What are some overlooked? I think this is the last question, but if not, then we'll kind of continue on. But what are some overlooked deductions or credits that real estate investors, especially passive investors, should be aware of?
So, I'll say this is that the most missed deduction I see on tax returns is insurance. So a lot of, now these are the people actually putting together the records. They just forget that insurance is tax deductible. Now, if you're passive and you're just getting a K1 and you're not doing very much, there's not a whole lot of deductions that you can take. So if you are the passive investor and you have no control of the finances, you're going to be relying on the other organizers and GPs to put together those records and sign off on the returns.
Yeah, that makes sense. Plus, you can combine it with a lot of the other strategies that you talked about earlier, especially with just outside of real estate. Or I like that one too.
Yeah.
If someone asks, I'll tell them, "Is your spouse a real estate professional?" That's always an option.
Yeah. Now, here's the thing: if you guys are if some of you guys are business owners, and you do have maybe some capital gains or events or whatever, you can consider using these funds to create losses in your business and deploy them in your business to mitigate any potential capital gains implications or anything else that goes on.
So I stuck this on here. If you guys want, you guys can take a snapshot of this. But maybe I'll turn it over to you, Mark. If people want to be able to get in touch with you, I was assuming this was the best way, but you tell everybody, what is the best way to get a hold of you?
Yeah, let me, what I would say is I'm going to put a link here for if you guys, so obviously, you just email info@markperlbergcpa.com if you're interested in using our help. But let's say you just want to learn more about our services. How do I type in the chat here?
There's on your,
right here, I see it.
I get you. Got
I have a link for, like, if you just want to learn more, we do free live webinars. And those webinars are, let's see here. Yeah, there we go. Those webinars are recorded. And so pretty much, we have about 42 podcast episodes. So you can find us on all social media. And if you want to get on our mailing list and see what we're doing, we are going to be offering courses to a larger audience. Right now, we're kind of limited in how many people we can serve. So we can't serve everybody, and we want to help everybody, but we are going to be releasing some courses and also delivering free webinars and giving away tons of insights. So if you get on our mailing list by following that link in the chat, you'll be in the know and you can keep in touch. And also just follow me I post daily videos on Instagram and LinkedIn, Mark Perlberg, CPA Tax. Follow our YouTube channel. We're always putting out fresh content and exploring advanced forms of real estate tax strategies and creative tax strategies.
Awesome, man. Again, I would highly encourage you guys to go follow Mark. Definitely, I've seen some of the videos. Definite plethora of information out there, and it's free. I mean,
Great, yeah.
Obviously, if you want to get a little bit more technical and get into some high-tech strategies and tax planning, definitely reach out. I mean, honestly, reach out to Mark and his team, and obviously, we can reach out to us as well, and we can connect you with Mark. This is us, the Rice Capital team. Again, we're more on the investment side of it, structuring, finding deals, curating those deals, curating the opportunities for you guys. We're here to educate, network, and create those relationships with everybody. So if you guys want to know or learn more, you can scan our QR code, takes you to our website. You can get in contact with us through our website. And that is it for the questions that I have. I need someone's help on the questions because I cannot see the questions.
I got you, Chris. Mark, thank you so much for all the info. It was gold.
Awesome.
You do have lots of questions from the group tonight. First one being, how does an LP or a limited partner investor tax advantage of bonus depreciation to reduce a W-2 income for a high income married file jointly?
Okay, so let me tell you about how it's possible. For most of you guys, it's not possible because you're going to have two buckets of income. You have active income and passive income. And generally speaking, the passive income losses won't offset your active income, but they will carry forward and offset other sources of real estate passive income. But here's how you could potentially make this work. The two situations. One is if you have real estate professional tax status and some form of rental income that you materially participate in. With that, now let me break down those two things that we need in place. One is we need to say either you or your spouse works full-time in real estate. And by full-time, I mean more than 50%, more than 750 hours in a real estate trader business. And the second thing we need to say here is that you put in at least 100 hours or 500 hours based on certain criteria into some sort of rental activity. Then you can invest in this passive income and you can group it in for this consideration, and the losses will offset your W-2. Now, if that sounds too hard, there's one other way, which is to invest into, is to have other sources of passive business income that's positive, and then that'll offset it, but it won't offset your W-2. So that's really the only way you can do it. So when it comes to winning the tax game, I wouldn't say not to invest into real estate, because we're not just investing to reduce our taxes. We want to build wealth and see it compound and see the advantage of depreciation, eliminating the taxation on your rent revenue. But what I would say you should do is you need to talk to a skilled tax advisor who can create other opportunities to reduce your taxes. That'll give you some refunds from the money coming out of your W-2. And now you have even more money to put into this tax advantaged real estate.
Awesome. All right. I'm going to go to the next one. Does bonus depreciation ever expire if you are not able to use it until the property sells?
So when you take that bonus depreciation, if you don't basically if it's not used to offset any rental income, it's just going to be carried forward. So if you look at your tax return, you're going to have what's called Form 8582, and you're going to have a reserve built up of any unused losses that are created from that bonus depreciation. And they'll be activated when there's a capital gains event or when your revenue exceeds your expenses from your real estate activity.
Gotcha.
Let me just throw one in there because I see people, there's a mishap on there. So the Form 8582, I'm assuming I got the right form number. Is that the right form number?
Yeah.
A lot of times what I see too, and I've heard of other people doing this, especially that are in the real estate game, like they'll change CPAs for some reason, and then they forget that it's there, and then they lose all of that because if the
Yes,
CPA
they do.
doesn't know about it, not Mark, but other CPAs.
Yeah, we
Will
caught some of our staff doing it, and we had to make the adjustments.
But I'm assuming you see that, right? I've heard it
Yeah.
on several occasions. Yeah. So if you guys are investing in real estate, make sure you guys keep track of that form. Make sure you guys have good records. So and find a good CPA where you don't have to change, like Mark.
Very common mistake. Yep.
Okay, well, next question is pretty interesting. Assuming depreciation does not provide a tax benefit towards a fix and flip project, are there any tax benefits to be aware of for a fix and flip?
Yeah, absolutely. So, first off, you're an entrepreneur if you're doing fix and flips, right? So just being a business owner gives you opportunities to create tax deductions. And I think every business owner should at least once in their life sit down with an advisor and figure out how can they maximize their tax deductions, which is awesome. It is awesome to have tax deductions, have business meetings with your spouse, hire your children, get bonus depreciation for your vehicle. You could create a retirement account. You could do some advanced entity structuring that we don't even have time to discuss in this conversation. Depending on how the higher your profit, the more fun and sophisticated and advanced your tax planning can get from that sources of income. But you're not going to be able to run cost eggs on those fix and flips. But here's an idea for you if you ever have an opportunity. Consider selling that fix and flip via lease option. So they become your tenant for a year to see if they like the place. You're incentivized to be good landlords because they want to buy it from you. And then when you eventually sell it, now you can 1031 and defer the gains or get the favorable long-term capital gains treatment.
Super smart. Okay, let me go to the next one. This came from LinkedIn. So should I invest in real estate through an LLC or personally?
So that's the question that relates more from an asset protection perspective.
Mm-hmm.
And I would recommend investing through an LLC just because if I had to choose with or without, the LLC does provide some form of protection. However, we also want to think, well, what's at risk here? Well, you're a limited partner, so you're not going to be liable for anything if things go, sour. But there are some other, and now a tax, an asset protection attorney would tell you more about this. There are some potential opportunities you can maybe create by saying that this asset is in the name of an LLC and not yours personally. You also might want to consider trusts for that, but that's you're gonna have to interview someone else to talk about that topic.
Let me know if you guys want to know about that. I have an attorney that actually creates trusts, and he can go over the entire structure on protection and everything else.
Yeah, you give me his info because our clients are asking us about it. We tell them the best we can, but we're not really authorized. We know the basics.
I would like that info too, Chris. And then I wanted to just add to this question because I think too there is a difference between what type of investment that people are doing. So we just talked about fix and flip here. And you talked about asset protection, et cetera. But then I think it might be interesting to expand into, the S Corp and just a regular LLC. Would you expand on that? really
Yeah,
quick.
for sure. So when your fix and flip income hits a certain level of profitability, oftentimes we'll put that LLC will elect it to be treated as an S corporation, and that'll reduce your self-employment taxes. So your FICA taxes will be significantly less. And not only that, there's something called the pass-through entity tax election. So again, just being a business owner, the more of your income is through a business that you own, the more opportunities you have here. So another thing with the S corp is if you're paying state taxes, there's a workaround called the pass-through entity tax election that allows you to deduct more than $10,000 of state taxes against your federal taxes by having those taxes being paid through your entity. And then there's also other cool things you may have heard of, opportunities like renting out your residence to your business, the Augusta rule. That's a nice little loophole. So tons of little strategies like that come along with being a business owner.
Awesome. Thank you so much for expanding on that. We do have a couple more questions. Another one from LinkedIn. What records or documentation should I keep track of for tax purposes as a passive investor? That's interesting.
Yeah, so when you're a passive investor, there's not as many opportunities, but you may find that you have the opportunity to have unreimbursed partnership expenses. I'm not sure if that'll be possible, but if you are incurring business expenses, investments, there may be an opportunity to write some of those items off. But for the most part, the fate of your tax return is going to be dependent on the K-1s you get from the organizers of the fund.
And usually, how do you claim the expenses? And I don't even know exactly how you called them, but how do you claim that? Usually, is there like a form or just through, personal bookkeeping?
So you on your tax return there, when you plug in your K-1s onto your 1040, you have an opportunity to have a section that's called unreimbursed partnership expenses, and it's added on as a separate line item to your partnership losses.
Okay. Couple more. The questions keep on rolling. Does the business ownership need to be specific to real estate, or can it be of another industry to use bonus depreciation?
Yeah, so we've done that's a good question. So you don't have to invest in real estate to see the benefits of bonus depreciation on a building. So we actually have a client who has a tree removal and roofing business, and they own the office space of where they're located. So we could do a cost segregation study to offset their income by accelerating the depreciation of the office space that they operate out of. And those losses will offset and be applied to their active income and reduce it significantly.
Okay.
So any type of building will offset whatever activity it's related to if you do a cost seg and get bonus depreciation.
Interesting. And then the last question we have here is, as a realtor associate, as a realtor associate and property manager, I have commission income as an independent contractor. What tax benefits should I be aware of?
Okay, so a couple of things you want to think about here is you want to be able to first off, if you're a realtor, big deduction here is going to likely be your mileage deduction. So you want to track that. And if you email me, I'll send you a template you can use if you've missed out on any of your mileage deduction. But you can also use, especially with realtors, because you drive around so much, use Mile IQ. It'll just attach to your phone, tracks everywhere you drive, and then at the end of the day, you mark off what did and didn't you use. Or if you don't use mileage, you might want to get a Jeep Grand Cherokee or some other vehicle that qualifies for bonus depreciation, write that all off. So that's a big opportunity that I see for real estate investors, is writing off their travel. And then some of the basic foundational opportunities here are, like we talked about earlier with the S corporation. Another incentive for you as an independent contractor and any independent contractor is a qualified business income deduction. That's a 20% tax deduction on your profit. Now, if this is your first time being an independent contractor, that all sounds wonderful, but now you're 100% responsible for your FICA taxes. So that's going to be a 15.3% tax before you even can look at your federal taxes. So again, the S Corp will help you mitigate that. And then finally, now, if you are a real estate agent, you have what is called the real estate professional tax status. So now you can start investing into real estate. And if you self-manage and materially participate, you can do cost segs on those investment properties and use those losses to offset your income and or your spouse's income, and potentially even group those with an investment into a partnership or a fund such as this one, where you're a limited investor and you can still treat those losses as non-passive, those losses that are created from the cost segregation studies, and they're going to carry on to your 1040 and potentially offset not only your commission income, but your spouse's W-2 or business income.
So essentially a win-win-win-win-win.
Absolutely. But it's, I once tried to do some work as a real estate agent. It's not easy work. So it is but there are a lot of opportunities if you're working in real estate.
That is wonderful. And that is all for our questions. I just wanted to say that Mark is my personal CPA. It took me 3 years to find him because, it is, like he said, it is very difficult to find someone that specializes in real estate. And his firm is just the best. I couldn't recommend it, any more than I already do to everyone I know. So Mark, thank you so much for joining us. And Chris, I'm going to pass it on to you.
Yeah, that was a pretty good close. Yeah, Mark, I appreciate it. Thank you for coming on. Thank you for spending the time out of your night. I know you're on the East Coast, so I really appreciate it. Thanks everyone else for jumping on. Those of you guys that joined us on the actual Google meeting, and everybody out there on LinkedIn, again, appreciate all you guys. Thanks for all the questions. Really appreciate that. Mark, you had any last words before we close this?
No, that's all I got for you right now. Thanks a lot for letting me talk, and happy to help anytime. And again, you know where to find me if you want to learn more about what we do. Always looking to add value and make new material and content out there. So I hope to continue to educate and provide great insight to my whatever audience we can find. So appreciate the opportunity, and let's have some fun.
All right, I appreciate it. Aloha, everybody, and we're gonna sign out. You guys have a great night and take care.